Well, what happens if for some reason, some administration says, you know what, your sovereign wealth is now ours. We're going to freeze your assets. Does it make a lot of sense to hold a lot of your wealth, your nation's wealth, in another nation that has such fickle behavior? So that, and the fact that there's no longer that big trade surplus to recycle into treasuries, it's a big, big dent in the demand for US Treasuries. And you take that, you say, well, if I'm going to sell treasuries and then I'm going to sell dollars, but I don't want my currency to rise, what do I do? Instead, I sell treasuries, sell the dollar-denominated treasuries, and buy gold. And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting.
Gold's market capitalization reached $14 trillion in 2024, surpassing the valuation of the US Treasury markets, which was $12 trillion. Central banks purchased a record 1,136 metric tons in 2023, with China and India accounting for 40% of demand. Unlike fiat currencies, gold's supply grows at just 1.7% annually, making it a natural hedge against inflation, which averaged 4.9% in G7 nations from 2021 to 2024. MichaelPento explains that nations are shifting from US Treasuries to gold to avoid dollar dependence. This strategic move is driving gold prices to new highs. He sees it as the early stage of gold replacing the dollar as the world's reserve asset. Over the past decade, the dollar's share of global foreign reserves has fallen from 66% in 2016 to 57% in 2023, signaling a gradual erosion of its hegemony. Concurrently, gold prices have surged to unprecedented levels, surpassing $3,300 per ounce in 2024, as central banks and investors seek alternatives to dollar-denominated assets. Regarding U.S. debt, MichaelPento warns that key buyers like China and Japan are retreating. As Japan sees better yields at home and global trade slows, support for treasuries is weakening, raising risks to America's financial stability. Looking at the big picture, MichaelPento warns that U.S. sanctions on countries like Russia have shaken global trust in holding American assets. Nations like China now fear having their wealth frozen arbitrarily. Coupled with shrinking trade surpluses, this is eroding demand for U.S. treasuries. Dollar-denominated assets made up 55% of China's official currency reserves at the end of 2019, the last official confirmation of this figure by China's State Administration of Foreign Exchange, down significantly from the peak of 79% in 2005. It was also below the prevailing global average in 2019 of 180%, 61%, according to International Monetary Fund data. Some of this may be offset by state banks holding more dollars, but China has steadily reduced its dollar exposure over the past 20 years. Before we dive into MichaelPento's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
China's one thing, you're right about that. I mean, we're talking about supplanting demand for our treasury bond market. What about Japan? Japan is the largest holder of our treasuries. And Japan, for a very, very long time, their long-term rates were 1/4%, less than 1/4%, on long-duration Japanese JGBs going out 10 years. And now they're close to 1.5. So they have a viable alternative. But then you have to also talk about the trade war, which spiked really the blow up in the bond market. Just think about this. There's two functions here. If global trade grinds to a halt, let's just say there's no longer a huge trade surplus for Japan and China to recycle into our bond market and currency. If that goes away, the bid for our treasuries attenuates significantly. And then you also think about what happened with Russia and these arbitrary, capricious sanctions that we impose on countries. Say, listen, your savings is no longer yours. We're going to confiscate that for you. Well, that started the belief that, hey, what if China is going to have a trillion, I think it's about $800 billion of their sovereign wealth parked into U.S. Treasury debt, and Japan owns $1 trillion, or whatever is a problem, the United States no longer thinks that they are our friend. I think you can ask Canada about that. What did Canada do to us? Suddenly, there's a lot of antipathy between the U.S. and Canada. Well, what happens if, for some reason, some administration says, you know what, your sovereign wealth is now ours? we're going to freeze your assets. Does it make a lot of sense to hold a lot of your wealth, your nation's wealth, in another nation that has such fickle behavior? So that, and the fact that there's no longer that big trade surplus to recycle into treasuries, it's a big, big dent in the demand for US Treasuries. And you take that, you say, well, okay, if I'm going to sell treasuries and then I'm going to sell dollars, but I don't want my currency to rise, what do I do instead? I sell treasuries, sell the dollar-denominated treasuries, and buy gold. And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting.
In this discussion, MichaelPento outlines the current economic situation and the likelihood of a coming recession. Pento predicts rising unemployment and reduced 401k contributions will lead to a 30 to 40% stock market decline, followed by panic selling, creating potential buying opportunities. Many of the probability estimates from experts that the U.S. will have a recession in 2025 or within 1 year fall within the 40% to 60% range, though some credible sources have lower and higher estimates. In early April, Wall Street company Goldman Sachs boosted its 1-year recession risk probability to 45% from 35%, which had previously increased from 20% in late March. According to Pento, the economy is grappling with the dual pressures of tariffs and reduced government spending. He cautions that the economic difficulties will continue to mount unless urgent measures like rate cuts or QE are implemented. Let's get back to the interview.
I think the way it's going to work, Don, again, unfortunately, the way it has worked for many, many years now is you have a job and you fund your 401k, and your 401k closet index the S&P 500, and the S&P 500 goes, it's just an indiscriminate buyer of every paycheck, as the fund flows are incredible towards the S&P 500. And you have the highest valued, because it's a market cap weighted index, you have something called the Mag 7, where you have them equal 40% of the entire index. It's just a function of math and the flow of funds. What I think is going to happen this time around, as we enter into a recession, which I'm almost 100% sure that we're going to see one this year, not sometime this year. We're already halfway there. Q1 is going to be profoundly negative. I would be surprised if it doesn't get even worse in Q2, unless we see an immediate cessation of the tariff conflagration, and we can get into that in a second. But it's hard for me to come up with a scenario where you're going to have a deal when one side of the argument doesn't even acknowledge the fact that we were having a discussion. So we're going to have a recession, and it might not be that deep, but it's hard for me to make an argument that you can see a flood of buyers for houses and a flood of buying into stocks, because this is, so as I can just finish my thought. So people start getting laid off. They stop funding their 401k when that happens. The market dives 30% or more, 40%. Then finally you get the attention of the individual investor, who is the only one really buying this market right now. The individual investors have never stopped. They have been so surely inculcated to buy every dip because the Fed and Treasury have your back, that they're just dying. This is like an opportunity for them just to, hey, buy every dip. And we can get into a reason why that's not going to work in a second. But so unemployment rate spikes, the market drops, the flow of funds into the S&P 500 dry up, and then you get the people who are employed always panic at the nadir of any bear market. They call up and panic and say, hey, they call the plan administrator and say, just get me out of my current S&P 500 fund. I want to go into cash. And then it goes from a 35% drop down to 50% drop. That's when you maybe start getting interest. That's when you see the buying. When you have forced liquidations of hedge funds and forced liquidations of funds in the shadow banking system, you could pick up some really good bargains. I think that's where we're headed, because I don't see any other way around it, unless you see a significant reduction in interest rates ahead of this, which is not going to happen. Unless you see QE happening very soon, it's not going to happen. In fact, they're still into a very mild version of QT. And unless all tariffs that were imposed from Liberation Day go to zero, not 10, 0, I think you're going to have a very difficult time. Because don't forget, this market was in trouble. The economic situation was in trouble ahead of the tariffs because of the fact that the labor force was shrinking. And the fact that, thankfully, the government was stopping all their hiring. The government was doing all the hiring. It was government and government contractors. That's why you say every month the non-farm payroll report was gangbusters, because 70% of them was a derivative of what government was doing. That stopped. So you have those two things happening. That's not a recession, but just means there's no growth in the economy. And when you add tariffs onto that, you get a recession.
The global financial landscape is significantly transforming, marked by a steady shift from US Treasuries into gold. The dollar fell while Treasury yields edged lower, helping send bullion higher by as much as 1%. The current outlook for gold is generally bullish, with experts anticipating continued price increases. As central banks hedge with gold and investors grow wary of US assets, could we be witnessing the beginning of a new global monetary era? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.